Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 30 minutes here on Options Guide TV. Today's date is Monday, March 4th. The markets are open. They're rocking and rolling. And on Friday's show, we had a special guest. Dan Sheridan came in and talked with me about some of his favorite strategies that he works with his students after all the years of mentoring. I've known Dan for a very long time, and he's mentored thousands of traders and has a very large community of students that he still works with on a weekly basis. So instead of looking at a butterfly, even a skip strike butterfly or a standard butterfly, one of the things that Dan brought up on the show is that if you want to get bearish on the market, instead of using a butterfly, which if the market goes down and you're correct, implied volatilities have a tendency to go up. So when that happens, that hurts the butterfly. The bottom line is on a butterfly, if you are correct on your forecast, that means you're at the money on the center of the butterfly where you are short two option contracts. So there's a lot of premium in those option contracts that you need to erode before that expiration date. So with that mentioned, we're going to take what he brought up in that if you look at a long calendar spread, it is actually positive volatility if you're correct on your forecast. And that if implied volatility increases as the market goes down, it helps that position. So never really thought about it that way. I've always kind of known that that was true with calendars. And as a matter of fact, with long calendars, which we'll go to in the options playbook here in just a second, but with long calendars, a lot of times where I've used them is actually around earnings, not on a specific company, and not to ride it into earnings. But if you know that earnings are coming in an underlying stock, you usually means that as that announcement approaches, the implied volatility is going to increase on the option contracts that are still alive. So a lot of times on a calendar, I will buy a month that the implied volatility would go up and sell an expiration. I say month, but I should have said expiration, and sell an expiration where it expires prior to that earnings announcement. And I'm going to close out that trade before the announcement because I want that boost in implied volatility. So this is a different way to look at it. And we talked about the SPX almost exclusively on Friday's show. So in honor of Dan and the great conversation that we had this past Friday, we went a little bit long on Options Guide TV, but that usually has a tendency to happen when Dan is talking, which I absolutely love about him, is that he does love this and he has a lot of passion for option trading and mentoring of option traders. So let's start by looking at the similarities between a long put calendar spread and a long put butterfly spread. Okay. So we're going to run to the options playbook. So we're going to start right here. And I do want to mention, if you want to check out the playbook, we actually set a record of books this month. The paperback is out. It's a brand new version of the options playbook. It's a little cheaper than the hardback was. And it's print on demand. So there's no inventory done by Amazon. And we actually sold a record number of paperbacks this week. So if you want to check that out, please just click on this link. It'll take you to Amazon and you can look at where the paperback is at. And that's probably where we're going to be going forward, is looking more so at the paperback and on the Kindles than focusing on the good old fashioned hardback that made the options playbook so popular. Okay, so I digress. Long calendar spreads with puts. This is the difference here between the long calendar spread, also known as a time spread, and I'll probably say that a few times. On the trading floor, it was called a horizontal spread, and that's just the way that the quote boards were aligned. You went horizontally on the quote boards. If you were down on the pits trading a calendar spread, you would be looking at the quote boards horizontally to get that quote. And here is the long put butterfly spread. So if you do a long put butterfly, this is what I mentioned, is that you're buying strike A. This is all the way down. That's the furthest out of the money. You're selling strike B, which is, there's going to be a lot of juice in those option contracts because you're selling two of them, and then you're buying strike C. So if I'm doing a put butterfly in the SPX, it's usually a directional thing. It means that the market is somewhere in this range. It's up here above strike C, and you want it to come down to strike B. If that happens, usually the VIX index will increase, but in general, the implied volatility on those option contracts would increase, making it hard to buy back the two at strike B, these two option contracts, because you want those options to wither away as expiration approaches. If you're correct on your forecast, if the stock is within the range between strike A and strike C, then you want implied volatilities to come in. And that usually doesn't, 90 plus percent of the time, it does not happen if the market goes down. People get a little bit more nervous. They call the VIX the fear index for a reason. On the way down, the VIX has a tendency to increase. On the way up, it has a tendency to decrease. So that's what a long put butterfly spread is. And most of the time we do this trade, if the market goes up, we make an adjustment. We roll into a short put spread. We would sell strike C, the most expensive out of all of the option contracts, and buy the least expensive, strike A, hence rolling into two short put spreads and bringing in a nice solid net credit to do that. And that's an adjustment that we'll make on a long butterfly spread. Now, I'm going to come up with the adjustment on, because you're going to see that it's very similar profit and loss graph, and we'll make an adjustment also to the calendar put spread. But now, if we're doing the calendar put spread, we're going to be dealing with two different time horizons. So here's the setup. You notice that, first of all, notice that the profit and loss graph looks very similar, but it's a little wavy. And usually, even if you read the note, you'll see that if it's got wavy lines, it means that you have two different expirations. And it's a little bit harder to judge the profit and loss because of that factor. But if I sell a put, and we call it the near-term expiration in calendar terms, that's always referred to as the front month, and then we buy the back month, one expiration month later, that would be the back month. Or in the world of weeklies and dailies, you're selling the short term, buying the longer term. It's probably a better way to say it in this day and age, because there's so many different expiration dates, and we now have zero DTE option contracts. So you're buying the short term, or you're selling the short term, and you're buying the longer term. That means that you're covered by the brokerage firm. And if you think about it, let's say the market's up here. Once again, you want it to come down towards strike A. Now, if it came down right away and you put this trade on and you sold this put, well, you got the front month that is decaying, but the back month, the one that you bought, has more time in it. So if you think about it, as expiration approaches, the front month is going to get a higher and higher rate of decay, where the back month is going to stay steady on the rate of decay until it gets closer to the expiration date. Now, that means that if you were correct on your forecast, the concept would be that you want strike A to go away, and it would in theory, because you would have that huge rate of decay. And then if that happens, the back month still has a lot of time. And options with more time premium in it are more susceptible to an increase in implied volatility. So if you're correct on this trade and it works out for you, you are effectively long a put. If this option contract expired, you would be long that back month put. And if you closed it out right after the expiration of the front month or the near-term option contract, well, then you're just long a put, right? And when you sell that put, you want implied volatilities to be up in value. So a little bit different in that I'm really in the calendar spread, hoping that I'm just long a put after this expiration. Now, if you trade it as a calendar, that would mean you would just sell that put out right away. Obviously, you can remain long, but that would purely be speculative. If I'm doing those type of trades, I'm actually looking at the diagonal, which you can check out inside the options playbook. So let's do the long calendar spread with puts in the SPX. Like I said, I normally would do these on an underlying stock when there's going to be an earnings report. And I would set it up so you're buying the further out expiration that would contain the earnings, and the shorter term expiration would not. It would expire before that earnings announcement. So we're going to do it a little different. We're going to use the index, and we're going to jump out. One second here. We're going to jump out of the options playbook, and we're going to go into the Hawks offer. All right. So when we look at the different expirations that are available, this Friday would be March 8th. So this is the Friday expiration. And so we're going to sell that expiration. And then we're going to go out one more week. And I'm going to have to scroll over because there's so many different expiration dates. So one more week would be the 15th. Okay. So the 15th is the second expiration. So we're going to start with March 8th, which is Friday. And we're going to go down right now about 1% in the market is basically, well, it's about 40 points. So 40 points, well, and the market's moving on me, is about 8%. So let's go 50 points down. Let's go 1. I like the 5,100 range, but let's go down to 590. That's 45 points. Okay. So we'll go right at the 590. The delta there's about 30, saying there's about a 30% chance that the market might finish 1 cent in the money by that expiration date. If you're riding it to that expiration date. And here's the March 8th. So we're going to look at this one. 30% chance on the 590, and that would be 45 points. I like it. Here we go. That is trading for 1730. And then we're going to go out another week, and we're going to buy that same strike. And this is the put side of the chain. And the 18th would be 14 days remaining, calendar days until that expiration date. Oh, then we want to go to the 15th, don't we? Yep. I want to go to the 15th, the 8th. So that would mean 11 days. Oh, I did I click on the right one? 1 second here. Yep, let me get rid of that. Here you go. March 8th. Go down to the 90s. March 8th expiration. All right, March 8th. And that is going to be this Friday, March 8th, and the 15th will be March 15th. That'll be the next Friday. So we're on the 8th. Go down to 590. We're going to buy that option contract. Then we're going to go out to the 15th. Oh, we're going to go back. We're going to go back to the 8th, and we're going to sell that option contract. 530. That would be 40 points down. Let's go to the 5. Let's do this one. Okay, we're going to sell that. And then we're going to go out to the 15th. And okay, so this is interesting. And I think this is how I got a little bit confused. And this is important because I like to trade a lot of SPX. One of the big things is that this is a normal expiration date in the SPX, in that this is a monthly expiration date, which would be March 15th. That would be the third Friday in March. And because of that, this option contract is a European style option. The W's are the normal weekly option contracts. So if you click on this, you're ideally trading an option contract that has a totally different terms and conditions of the option contract. You want to make sure that if it's SPXW over here, which means they stop trading after the close on Friday, that you click on the one here that also is the W in that instance. So we're going to click on this, and we are at the 590, and we're going to buy this. All right, so now if we do this trade, 590, 380, we're doing this for a net debit of $11 to the account. That means it's $1,100 to put this trade on. We're going to do it for 1 week. If the market goes on up, we're going to adjust the trade, and we can adjust the trade. One of the adjustments that we can make is we can close out the short option contract, and we can roll out 1 week in time and roll this into a short put spread, which is bullish. Much the same that we did with the what our normal adjustment would be on a long butterfly, we're going to do here with the calendar trade. So we can either stay, depending on when we need to make the adjustment, we can either stay in the week of that expiration of the short option contract, which would be March 3rd, or we can always roll out to the 15th, which is going to add 7 more days onto that trade, or calendar days. So we're going right now, we have 11 calendar days on the March 15th expiration. On the 8th, there's 4 calendar days until that happens. All right. So yeah, that's going to be our official paper trade for the week. So we're going to try this. This would be, once again, not meant to be a recommendation. First time looking at a horizontal or a long calendar spread in the SPX as an alternative to the butterfly. We do add a little bit more risk than we did with the butterfly, but you also have another week of expiration to work this trade out, and we'll try it. We'll go for it. So if you have any questions, please make sure that you put them in the chat box, and we'll try to address them on the show. Last week, we did a skip strike butterfly, and we also talked about that one with Dan, and we came very close to, once again, we've done this a couple of times, where we came very close to the short strike of our skip strike butterfly. We needed 1 more day. The market did rally going into it. It was a profitable trade if you got out on the open, but if you rode it all the way to the market hurt you. The market rallied strong at the end of the session on Friday. And now, I look at the VIX is still trading right around 13 in the VIX index. It's up a little bit today. We did obviously have the news in Apple, and Apple is probably what's hurting the markets the most right now, in that it's down $4.82 or almost 3%. Apple has been fined by the EU for their practices with their music app and things that are involved with it. So with that mentioned, there's a $1 billion type fine that they're talking about with Apple. I'm sure it will all flush out a little bit, and it's a little bit of panic in the market, but that makes it really hard for the S&P 500 index to stay positive when you got a 5-point move to the downside in Apple, or 3% move. Now it's already bounced back a little bit. It was down a little bit more. It was down over $5 on the open. So ultimately it will flush out. Apple has not really, well, they've responded. They've given a quote as to what they think is going on, but I'm sure that there's a lot of litigation that's going to happen before that fine actually gets administered to Apple to see where they're going to be at. The Russell 2000 index. Okay, so it's at 207.01. So let's pull up the chart on the Russell 2000. And last week we also looked at doing a long straddle in the Russell 2000, and we finally might have a breakout that's happening. Now, the Russell 2000 index is a small cap index, but one of the things, and I saw this today and it just made me think of it, is, companies like super micro computing are in the Russell 2000 index, and the Russell only rebalances in June. That's when they have their major rebalance period. It is going to be, I don't have the exact date as to when in June, but it's easy to find. I thought I jotted it down. But I've had friends that there's a lot of trading activity, and it's one of the most, like, the IWM is the Russell 2000 ETF. And that's what we did the long calendar, or the long straddle in, was IWM. And it did work out. Now, it wasn't as clean as some of the straddles. Like when we bought the long straddle when the market was down here based off of where the chart was at, that one obviously was a no-brainer because the market just went straight up. In this instance, we're right below 200, 197.50 is where the market was at, looking for this breakout, because we see the level of resistance that we had, and we came back into the channel. You're right here, and the Russell will get a little messy. I'm surprised how defined this chart was, and I mentioned that this channel was such a good channel for the Russell. But I digress. Once again, I've done that a couple of times today. Super micro computer is just set at an all-time high, and it's still in the Russell 2000 index, and it's in the S&P 500 or S&P 600 small cap index. So obviously that needs to get out of there. That's probably a big reason why the Russell is looking stronger at this point in time. Now they're saying that SMCI is as big as FedEx, so it's obviously no longer a small cap stock anymore. And in June, when all the trading volume, or when a lot of the trading volume in the Russell 2000 increases, one of the things that a trading strategy that's more on the stock side of things, because you're dealing with small cap stocks, the options aren't quite as liquid, unless you're looking at SMCI, but they're not as liquid. So you're just talking about stocks, is just trying to guess what's going to go in the Russell 2000 index. If you guess wrong, the stock doesn't really move much, but if you guess right, that stock will usually pop. So a little less risk to the downside on the stocks that don't go in, because they just didn't go in. That doesn't really change the fundamentals of the company. But if they do go in, they have a tendency to pop a good percentage. So just interesting to keep in mind. They're definitely going to have to get SMCI out of that index, and that is going to affect the index when we get to June. So thought I'd bring that up because I did see that SMCI hit a new all-time high. So that market ran up, and now it's at 207. It looks like it's on its way right here. If we go up to about the 211 range, this is the bottom of this big gap down. So we would be filling the gap right about there. And, gaps in general need to be filled. And not to mention, we had that down, and then we had that calendar to the upside. So that is a next important point on the chart, is around 212.37. All right. Well, we're going to leave it right there. We will look at and follow closely our first put calendar as an alternative to the butterfly in the SPX for this week. And we'll look to make that adjustment on Wednesday when we come back, if the market continues on up. Right now, I feel like the path of least resistance is a little bit to the downside. There's a lot of people, and there's the excitement of the marketplace is a little bit too high. I think the market in general, the feel for the market is a little bit of irrational exuberance has driven the market higher. Have a tendency in March is usually a month that if you've had a strong market, you get a potential sell-off in March. So I don't mind being short the market. And we talked to Dan Sheridan on Friday, and this is one of the things he likes to do. He likes to combine this trade, and I should finish the thought with doing a put calendar spread on the downside and a put butterfly or a call butterfly trade on the upside, and just try to get some time decay in the option contracts. And that's a normal trade. So with that mentioned, that's it for this edition of Options Guide TV. We'll be back this Wednesday at 11 a.m. Eastern time, and we'll see where this trade is at. Please click subscribe, ring the bell if you're on the YouTube platform, and you'll get all of the reminders for the next edition of Options Guide TV. Thanks for coming, everyone.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc. All rights reserved. Member FINRA SIPC.